Hello and welcome to the Gryphon Financial Partners presentation on the current economic and market landscape. Here at Gryphon Financial Partners, our purpose is making people's lives better. And what we're going to try to do today is try to walk through, the current market, the current economic environment, and an update to where we think things are going for the remainder of 2026 and even into 2027. So I'm Mark Fleming, Senior Investment Director here at Gryphon Financial Partners. I have over 20 years of experience working across hedge funds, long-only investment funds in both private equity, and also making economic forecasts. Joined with my colleague, Bob Swansboro, Senior Investment Director. Bob brings over 25 years of investment experience across equity trading, equity research, and portfolio management. So today we're just going to dive right in to our presentation. And we're just going to give a quick overview of, what we said during our last presentation. Our last presentation was a review of 2025 and what we expected in 2026. And then we're going to revisit some of these issues. So, just as a reminder, this is the exact same slide from our outlook for 2026 that we gave at the beginning of the year. We haven't changed a thing. So one thing that we mentioned was the lagged effects of past rate cuts would drive growth in 2026. We said that fresh federal stimulus that had already been passed into law would be driving spending and investment. We felt like households came into the year in good shape, and then that would set them up well for 2026. We thought markets were fairly valued, and analysts were really expecting strong growth, so 15% for 2026 and 2027, and we generally agreed with them. So throughout this presentation, we'll touch on each of these topics and see how things are trending, versus how we expected. So with that, I will hand it over to Bob, who will give us an update on how the market's performed so far year to date.
Thanks, Mark. So if we look in terms of what has happened so far in 2026, despite the Iran conflict and everything that's going on geopolitical-wise, the markets have remained on strong footing so far for the year. In my mind, the broader takeaway is investors are looking at things like fundamentals and earnings, and that's how they're placing their decisions. When you look at the returns so far this year, S&P 500 is up around 10% or so. International stocks are up around the same, but the market's been led actually by emerging market stocks, which are up close to 30%. And we also have small cap stocks represented by the Russell 2000, up about 22% for the year. So pretty much across the board, it's been a great year in terms of the market itself. Just to make mention, on the fixed income side, bonds are relatively flat for the year, but nonetheless slightly positive. So again, good start for the year. We're going to go through some of the reasons for that in our minds. If we flip to the next slide. So clearly, one of the largest or clearest themes, I should say, for the year so far has been certainly strength in AI spending, things around building data centers, those types of things. I'm sure you've heard a lot of that over the news, but that spending continues to drive the economy. And we've seen leadership, in many spaces within technology, including memory and compute. And this is what the slide actually depicts. It shows you the rise that we've had in those areas of technology. One area of technology that has not participated thus far this year has been software stocks. And the main reason for that, there's concerns over software subscription products may become obsolete with the development of AI. So, and reduce revenues for those companies, things of that nature. So again, software stocks have not participated, but when you look across the board, it's been not only memory, but CPUs, those types of even traditional areas in terms of technology. So, and just one other thing to make mention of, all this spending in terms of data center build out and such, that has actually a trickle-down effect. So when you look at companies, for example, like Caterpillar, some of the utility companies, they are also participating in the rally because, again, we're going to talk a little bit about numbers in terms of the spending a little further ahead. But nonetheless, we've seen that trickle down to other areas of the economy as well. I mentioned earlier about memory pricing. You can see it's up around 400% according to this chart. Um, when you look at some of the companies that actually are in this space, for example, like Micron, SanDisk, Western Digital, a couple other foreign companies as well, their stocks have actually tripled this year. And again, this is one major theme, I guess, with inside the AI theme itself. So, and one thing to note, when you look, for example, I had mentioned earlier in terms of emerging markets this year have actually been led by two countries in terms of their markets, been South Korea and Taiwan. And the reason for that is they have a lot of exposure within their markets to chip stocks as well as memory companies. So SK Hynix, as well as Taiwan Semiconductor. So again, a big theme within the AI theme itself has been memory pricing. We've also seen a surge in terms of AI token pricing, as shown in this chart as well. Again, just plays in with this theme. And what this shows is usage and demand at the application level is strong as well. So again, just playing into that overall AI database build out type theme. I had mentioned about spend. When you look at what the hyperscalers, and those are listed on this chart, Alphabet, Amazon, Meta, Microsoft, you can see how much the consensus forecast has grown in terms of their spending with regards to CapEx. And again, a lot of this has to do with AI related type themes as well as data center build out. And you can see that spending it numbers into the hundreds of billions of dollars and it continues to grow. We've seen a lot of companies actually issue debt or equity to fund the spending as well. So you probably heard that a lot in terms of a theme on the various news sources. But again, the spend continues to grow and it is certainly driving the economy as well. Maybe just shifting gears just a little bit. While the growth backdrop in terms of the economy remains supportive, inflation is something that we're still keeping a close watch on. More recently, energy has been a meaningful driver in terms of the inflation numbers, which helps explain why inflation has remained a little firmer than was thought at the beginning of the year. But as you can see from this chart as well, when you look at core inflation, which factors out more volatile energy and food prices, those numbers have remained, rather tame in terms of what's happened. So, it's certainly been a spike in energy prices that's been driving inflation here. So. What else we've seen in terms of the rising inflation numbers, we've seen yields on treasuries actually move up as well. This matters a lot because higher rates can create some headwinds in terms of equity valuations. And also, rates have an effect on certain sectors of the economy. Probably more greatly would be housing. So, we've seen housing, it's sort of lagged in terms of its recovery. So again, we continue to watch interest rates, but inflation has certainly pushed yields up here over the past months here in terms of 2026. Another reading that we keep an eye on, of course, is nominal GDP growth, and we've seen improvement in terms of those readings, which reinforces the idea that the economy is still expanding at a solid pace. From an investment standpoint, this is supportive for revenues and earnings. As you can see, the last reading that we had in terms of nominal GDP growth for the first quarter, that number was actually up about 5.1%. on an annualized basis. So again, we've seen strong numbers in terms of GDP growth, which has also been supportive to the equity markets. And I'll turn it over to Mark. I know he's going to go over some subjects with regards to we have an election coming up and some other things around some statistics around that.
Thank you, Bob. And yes, 2026 is an election year. So we have the midterm elections coming up in November. Historically, midterm election years tend to be among the weakest for the market. Now, this year, looking at the economic and company earnings, we don't think that should be the case. But what should be the case and what actually happened are not always one and the same. We think the market probably should look through the election and really, not be overly concerned about it. We think any possible outcome is probably neutral for the market going forward. But the market tends to, even in years where that's the case, where no matter what the outcome, we're likely to have the same economic forecast going forward or the same market outlook going forward. The market still tends to react to the election cycle. So we've talked a lot at our last presentation, and we're going to talk a lot today about strength in the U.S. economy. So we think the economy is doing well. We think companies are doing well. But we do think there could potentially be some pressure on the market, or maybe just holding the market where it is from now until up to a few weeks before the election. So if you see this chart here of historical election cycles, we tend to see the lows before the election. So the market tends to react to something before the actual event happens. So you would typically see a market low in October for the November election. So we don't think the market should react to that this year, but again, we think it's possible that it could. So tracking the election odds, we're using Polymarket, the betting markets, as kind of the guide here of, what consensus is and what the outlook is for the elections. Right now, they're pricing in an 82% chance that the Democrats take the House, and there's currently a 56% chance the Republicans keep the Senate, which looking at some of the data, we think the odds of the Republicans keeping the Senate are probably mispriced. It kind of looks like we're moving towards both houses being democratically controlled. But given that the White House is going to be Republican, we don't think that's going to have a big outlook for policy. Gridlock has tended to do well for markets and for companies. And generally, the way that I look at that is if I put my hat on as a business owner, if I know what the rules are, I can run my business according to those rules. If I don't know what the rules are, I can't run my business. So even if you had really bad policy, and we're not saying there's bad policy right now, but even if there was bad policy, if that policy is known, then business people can conduct business in that environment. If the policy is unknown, it becomes much more difficult. So gridlock is generally favored just because laws tend to, no new laws tend to be passed. So the current rules of the road tend to be known in that environment. So, that's where we don't think it's going to have a big impact on the market. So looking at the races here, so if we look at the contested races, so the purple dots for the Senate, essentially we have 5 contested races according to Polymarket to determine who's going to control the Senate. Really, we only need the Democrats to win 2 of those races for the Democrats to take the Senate. So, just tracking the individual races, of those 5, we have 2 where the Republican is leading, 1 in Kentucky, pretty solid. Texas is more of a toss-up. And then we have 3 other races where we have the Democrat in the lead. 2 of these pretty well in hand, Illinois with 94% odds, North Carolina with 86% odds. So that would point to a shift in control within the Senate, which again, we think we're keeping an eye on it. We're always watching what's happening in DC, but we don't think the outcome of this election is really going to drive our view of markets going forward. Our view is always based on the macroeconomics on the ground, and we're going to spend the rest of the presentation talking about those. So we introduced this hope framework for looking for the future and kind of how to guide through the economic cycle during our last presentation. It's really looking at kind of the order in which different factors react throughout the economic cycle. So housing tends to be the first mover, both up and down, and that's because it's the most sensitive to monetary policy. Orders, specifically orders for manufacturing, which is measured through the ISM index. That tends to be the next mover, followed by corporate profits. And then that flows into employment, and then ultimately inflation being one of the slowest reactors to economic inputs. So as we start to look at some of the components of that HOPE framework, we're going to look at this, which this chart here is my favorite indicator. So we're going to take a little time to break it down. And if I had to choose just one chart to look at, this is the one I would choose. And when I came to Gryphon from another firm, we got our Bloomberg set up. The first thing we did is we set up this chart. So what this is the orange bar. It's called the aggregate labor income, which sounds really technical, but it's really a fairly simple concept. So it's just the amount of money that the workers in the economy have to spend, and it's measuring its year-over-year growth rate. So the way that we come up with this number is we take the number of people working, the hours that they worked, times their hourly wage, and then we just see how that's growing over time. And that gives a really good look at GDP and how much people have to spend. Now, one thing that's great is we have another indicator, as we talked about in that Hope trade, orders. So ISM manufacturing new orders. That typically gives us a 9-month lead into how wages are going to react. So in a way, it tells us the future. So where orders are today is telling us where the economy is likely going to be in 9 months. And so we have the chart here kind of in the background that just shows the history of the chart and how good of a job it's typically done of showing changes in direction of the economy and where we're going. We do have to cut out the COVID period because the COVID kind of messes the data a little bit. And then we come back in the post-COVID era. And so we see this blue bar, which is the new orders. We see that ticking up. Our last presentation, we had said that we were expecting this to tick up. There are some indicators that actually lead new orders. So it gives us an even, bigger lead of where things are going. And, right now today, aggregate labor income, it's at a relatively low, 4% growth. Now that 4% is not adjusted for inflation. But we're indicating that we're going to see a pretty strong uptick through the second half of 2026 and probably carrying forward through 2027. And now this next chart just breaks down that index, because one thing, if we want to know, we really want to know where things are going, not where they've been. But sometimes really understanding what's driving where we are can help you understand where we're going. So this chart just breaks down those three components. So we have the blue, which is the workers. The orange is changes in hourly wages, and the gray is the changes in hours worked. So, if everyone across the economy is working an extra 30 minutes, that would have a massive impact on the overall income of the economy. So we do see that when we adjust this for inflation, so one difference, our last chart was not inflation adjusted. This one is. We adjust the orange bar, the wages for inflation, because if someone gets a 2% raise and inflation went up by 2%, in real terms, their wages stayed unchanged. So what this is measuring is the inflation adjusted changes. And we can see that we've really lost the contribution from the blue bar, which is new workers coming in. And recently, we've lost the orange bar, which has been the inflation portion. Now, a lot of the inflation has been driven by the war in Iran and more temporary factors that we expect to reverse in the second half of the year. So in the where things are going, we expect to see a pretty significant contribution from wages as that negative effect of inflation starts to roll off. And we'll expect to continue to see labor force growth, but generally population-wise, we do have a tailwind just in the number of working age people that we have, or headwinds in the number of working age people that have, that make that number more difficult to see growth. So again, looking at that new orders, that is so important because it leads where the economy is going. This blue, in this one, the blue is the new orders. Or, I'm sorry, the orange is the new orders, and the blue is 2-year yields. And so that's really just a proxy for monetary policy. And you can see that monetary policy with a 18-month lead has a pretty good guide to where manufacturing is going. So a couple slides back, we said that new orders are going up, and we think that's going to drive nominal GDP and the money that consumers have. And of course, that'll drive earnings and that'll drive the stock market. This is showing that, with the lags effect of monetary policy, we still expect further growth in that new order component. Now, one risk to that is the oil. So during the Iran conflict, we saw a pretty dramatic increase in oil prices that typically has a negative effect on the economy. It's equivalent to, this move was probably the equivalent to about a 75 to 100 basis point change in Fed funds rate. So equivalent to 3 to 4 interest rate hikes. So that's going to signal trouble ahead. So there's typically a 12-month lag in between when oil prices really hit that new orders component. What we'd expect to happen is, since it was such a shock and likely going to be a relatively short-term shock in oil prices, so our expectation is that we'll see this reverse itself. So we have an orange downtick here that's showing the change in oil, and we expect that to effectively reverse itself pretty quickly. And I think that'll just end up being noise, rather than signaling a rollover in the economy. And how that flows through to interest rate policy. I think during our last presentation, the market was expecting rate cuts. We said that we thought there wouldn't be any. Today, the market is actually expecting rate hikes. Again, we don't expect there to be any. It really wouldn't make sense to raise rates here. And we think that the new regime with Kevin Warsh is going to look at things slightly different. So we still have some members of the Fed that have been signaling that they would like to see higher interest rates in response to inflation. And that inflation is an effect of the Straits of Hormuz being closed. I think there's many members of the Fed, including Kevin, that know that raising interest rates is not going to open that waterway, and it's not going to be helpful for the economy, because that oil spike is the equivalent, again, to 3 to 4 rate hikes. So the way to fix that problem wouldn't be to throw additional rate hikes. That would just cause a unneeded, unwanted recession that really doesn't help anyone. So we think the market probably has this one wrong again. They had it wrong expecting a lot of rate cuts. Now we think they have it wrong expecting a lot of rate hikes. And the good news is that we're not alone in thinking about that. So this chart shows the concept of the long-term neutral rate. So the neutral rate is the interest rate where the Fed is neither stimulating the economy or trying to slow down the economy. And it's kind of a measure of whether we think whether the market thinks the Fed has monetary policy right or wrong today. And so the orange bar is the market outlook of where Fed funds should be. The blue bar is where Fed funds actually is, and the gray is where the Fed says their long-term dot is. So really right now, the market thinks the Fed's in the right spot. So the market agrees with us that we're unlikely to see any interest rate hikes, despite the Fed funds futures trading in a way to signal potential hikes. And we also looked on, now that we have those poly markets, starting to show odds of hikes. That's showing about a 60% odds of an interest rate hike, and we would just disagree with that. So one risk to that outlook and to the overall macro outlook would be a spike in inflation. If we did see a dramatic increase in core inflation, the Fed would have to respond with some type of rate hike. So this chart, we're really just looking at core inflation against commodity prices and how long it takes for commodity prices to bleed into that core inflation. And it typically takes about a year. And one of the reasons is because in core, we strip out food and energy. Most commodities are food and energy related. But it's still both the food costs and the energy costs eventually bleed into the costs of everything else, but it takes about a year. So again, we see a spike in commodity prices. A lot of that was driven by fertilizer prices and the price of oil. We're already starting to see that come down, and as the straits open, we're expecting to see a glut of both, and we'll see a pretty big reversal of that. So again, we think this is going to end up being noise in the data. We don't think we're going to see core CPI end up actually following that increase in commodity prices. And one of the reasons why we think that is ultimately for a price increase to stay, wages need to follow. So if we look at wages and things that tend to predict wages, one of the things that predicts where wages are going is the Indeed wage tracker. So it leads what would be the Atlanta Fed wage growth index by about 9 months, and Indeed's measuring things in real time. So that's really just what's happening today versus the Fed is looking at some lagged indicators. So as we can see, it looks like wage growth is stabilizing rather than spiking. And another way to look at that is quit rates. So in the bottom chart on the right, we're looking at quit rates from the JOLTS data. And it's showing that people aren't leaving their jobs. Typically, when people are leaving their jobs, they're leaving for higher paying jobs. That puts upward pressure on wages. So without the wages showing the follow through from the commodity prices, we think the market will end up looking through and the data will end up looking through that spike in commodity prices. So Bob, you want to take that to how it's going to affect the market?
I can do that for sure. Next two slides pretty much go hand in hand, and I'm sure Mark would agree. We've been getting a lot of questions from clients in terms of market valuation. When you look at the S&P 500 over the past 20 years, the forward PE ratio typically averages somewhere around 16 to 17 times, as depicted by this chart. When you look where those measures are today, the S&P 500 forward PE ratio is somewhere around 20 to 21 times. So if you look at that measure as a standalone, investors would think, well, the market looks, expensive from that basis. But our argument is, there's some other things that you have to factor into that. And if you flip to the next chart, Mark, um, we think you have to consider profitability when looking at market valuation. Um, and when profit margins are strong, investors are often willing to support higher valuations. And this chart suggests the market may be more reasonably priced than what appears first glance on a PE basis. What we're doing with this chart is actually plotting profit margin versus PE ratio, and we're going back basically for a 20-year period. When you look at out to the far right there, where profit margins are for S&P 500 companies on average, you can see that dot is further out to the right with about 15% on average in terms of profit margins. Our thoughts are, investors are willing to support a higher valuation based on the fact that companies are coming in more profitable as measured by profit margin. If you look, next slide, please. If you look at, in terms of earnings for the first quarter, they were projected for first quarter this year, I should say, they were projected to grow somewhere around 14% or so. And we pretty much had surprise across the board. That actual growth for the first quarter came in at 27% year over year. So again, just another measure that's telling us that the market is supporting the fact that it may look a little expensive on a PE basis, but earnings are certainly coming in stronger than what's expected for some of the reasons that we had mentioned earlier. And we think the market could support that higher valuation versus average. This chart sort of looks at the history of S&P 500 earnings expectations, and they continue to step higher over the next 2 years. The rising earnings path support the case for broader market participation, including the idea that more cyclically sensitive areas of the market, such as small caps, may benefit as we move forward. As I had mentioned earlier, small caps have been a leader this year, and hopefully we see this progression in terms of large cap outperforming small cap. We hope to see a catch up in terms of small cap earnings as well as returns, and we've started to see a little bit of that this year. So.
Thank you, Bob. And then turning over to the often less discussed portion of the market, the bond market. Looking at corporate spreads, so this is just how much more investors are requiring in yield from risky corporate borrowers than lending to the U.S. government, which does not have any credit risk. We see that credit spreads are really tight, around about 1.5%, which is for bond investors is a historically tight spread. So it's historically a small reward for taking that risk. We still think that corporate bonds, are an attractive place to invest, especially where overall yields are today. You can get yields anywhere between 4.5%, 5% in the corporate bonds. That's a pretty good yield. But that spread is historically tight. Now, the good thing about the spreads being tight is typically wide spreads are a sign of trouble. So it's showing that the economy is doing pretty well. People are paying their debts, and that we're in good shape. And it would be alarming if we were starting to see spikes in these numbers. And if we look out the risk spectrum to high yield bonds, or as they used to call in the 80s, junk bonds, you still see historically tight spreads, which is, again, means that your reward that you're getting for taking on that additional risk is smaller than it has been historically at about 2.2%. But it's also showing that the bond market thinks the economy is in pretty good shape. And really, if you try to break down, why we're at historically tight yields here, one of the factors is similar to, like we said, in the stock market, where you're getting higher quality companies within the index as measured by the profit margin. There is somewhat of an aspect that we're seeing higher quality companies within this high yield index than were there in the past. And the same with that BAA, which is the more standard credit, corporate credit that we had shown before. So some of this tightness is due to having higher quality companies in the index with a lower likelihood of defaulting than what used to be made up primarily of highly cyclical indexes. And a lot of that riskier debt has been pushed into private credit, which doesn't show in these charts. And so lastly, I think you'll probably see this chart from us a lot. Just talking about the market and all-time highs, there's always this, I don't want to invest when the market's at a high. And really what this chart shows is just there really isn't that much of a difference in return based on when you invest, whether it's at an all-time high or at a different point if you're looking at very long time periods. So the entire history of the S&P 500. So, just because the market's at a high, doesn't mean that you don't want to invest. Now, obviously, there could be a time where we're saying the market's at a high and we see the economy in a downturn and the market has it wrong. And then that, might be a different story. But today the market's at a high, the market should be at a high, and the market should continue to do well. Now, we can always be wrong about that. And that's where we're always mindful of both sides. And obviously predicting the future is a very imperfect game that we're never going to get right. But we'd say don't fear the all-time high. So looking back at revisiting that first chart, and so we covered a lot of topics here that we had mentioned at the beginning of the year, and we just want to take inventory of how things are doing versus what we'd said. So again, the first two bullet points here, the lagged effect of monetary policy and fresh federal stimulus are going to support the economy. So far, the economy is doing pretty well this year, and especially considering that spike in oil and gasoline prices. And really what we saw is, we were expecting 2026 to be the largest tax refund season in history. It was, but a lot of those tax refunds went to pay for people's gasoline. And so that absorbed what could have been spent on, things like appliances or vacations or other things. So it definitely dampened what the economy, how strong the economy could be, but it got the consumer through that tough period of high gasoline prices. And as we see the straits open and really a glut of oil, because the Middle East, those wells have been producing this whole time, and there's lots of oil sitting inside those straits that wants to come out. As that floods the market, we'd expect to see gasoline and oil prices come down, giving those consumers some relief in the second half of the year. We still think, the thesis that the households came into 2026 in good shape, again, held true and shows somewhat by how they were able to get through that oil shock and still be in good shape. And we still see strong consumer spending. Markets have actually gotten cheaper. So in our thesis that the market being fairly valued, you could say maybe we were wrong and the market's, correcting the prices. We don't think so. We think it's just really the negative sentiment from the Iran war depressed prices in the stock market. So while companies were growing earnings and companies were becoming more valuable, their stock prices weren't going up. And that's really where we've seen a big adjustment in market value. So the market got a lot cheaper from the end of last year through today, and it got cheaper by growing earnings, not by prices going down. So we still think the market looks pretty good. One thing we definitely got wrong was the analysts expecting 15% earnings growth for 2026 and 2027, because as Bob said, earnings growth has been much, much stronger than that. So we still see a tailwind in earnings driving the market forward. So we have a few questions that were sent in, and we're just going to take a little time to go through, some of those questions. A lot of those questions were related to, a stock market bubble or the bubble bursting or, some variation on that question. I think, probably from our presentation here, you'd see that we don't think we are currently in a bubble. Just because the market's doing well, doesn't mean there's a bubble. Even those memory stocks that have gone up hundreds of percents within really a 6-month period, it's supported by earnings and some underlying fundamentals. And we saw it in the chip pricing and demand for tokens. And it seems to be somewhat justified at this time. And it's really because we're just scratching the surface of the use of AI and AI agents and things that they can do for us. We're really at, one.
Mark, we've lost your sound a bit.
Hear me now?
Yeah.
Good now.
So looking at bubbles, we don't think that there is one. And, we looking at memory prices and, the stocks that have really shot up, we do think eventually we will see an overbuild in data centers, but it's not today. We're still underserving the demand for AI. And eventually, since there is it takes 2-3 years to get a factory going, at some point, the level of semiconductor fabs will exceed the amount that we need, and we'll see a correction. But that's just not today, and we think it'll probably hold for a few years. So Will there be an AI bubble? Probably eventually. We just don't think there's one today. Obviously, again, like anything, when you're looking forward, we could be wrong, but we're following the data, very closely and trying to keep a very close eye on it. We had another question about the market absorbing, IPOs. I think a lot of these questions were actually before the SpaceX. But we still have a lot more to come. So we still have OpenAI and Anthropic. And, really, we saw the market did a pretty good job absorbing the SpaceX IPO. There was, some sell-offs, minor decline in prices heading into the SpaceX, but the market seemed to absorb it pretty well. SpaceX was about an $85 billion IPO, which was the largest in history. But a lot of the private AI companies have been doing $120 billion rounds. So really, relative to the private rounds that we've seen in the space, it was more in line with kind of what's going on in the market. And there seems to be enough capital out there to absorb it. Our perspective and how we look at things here at Gryphon, we try to look at things as longer term investors. And, honestly, so if the market does have a bad week because there's a couple of big IPOs, that's probably one, it's an opportunity for longer term investors to go and buy some stocks they plan to hold. Or if you're just going to kind of ride through it, what's one bad week, right? So, while we never want to, completely dismiss, how difficult it can be to feel volatility, but if the market's weak because there's an IPO that week, I wouldn't worry about that. And if anything, and Bob's talked about this a lot in some of our meetings, the IPOs are really a good signal of the health of the market. It's really good for the spirit of the market, and it's really good for wealth creation because that money gets recycled, back through the venture capital ecosystems and new companies get started. So there's a real positive effect of those IPOs that really, even if we were to have a bad week ahead of an IPO, I'd say, we shouldn't worry about that too much. And then the last question we had here, if you could invest in one asset class, for the next 10 years, what is it and why? We'll both answer this. I got a feeling we'll both give the same answer. And one, it's really going to depend on your, personal situation, right? How much risk you can take and what mix of investment you should have. Typically, stocks tend to be the best asset class for building wealth over time. Bonds tend to be the best asset class for preserving wealth over time. Most other things are just noise that come and go. Those have stood the test of time for hundreds of years. So really depending on your objective, it's stocks to build wealth, bonds to preserve it. And when I say stocks, I also include private equity because both are business investment. And when I say stocks, we're talking about just buying a company. And there isn't much difference between Apple and a private business.
I'd certainly agree, Mark. And, when you look over a long period, there's stocks have, exceeded the rate of inflation. You certainly have to keep that in mind. And, we always tell our clients that we're long-term investors. So of course, risk tolerance and time frame, always play into that. But for sure, I would certainly agree stocks are the best investment over time.
So we want to thank everyone for joining us today for our mid-year check-in. We still think that the economy and the market are in good shape, and we expect that to continue, even though there's a chance we might see some weakness around the election cycle, and we would view that weakness as opportunity. As always, if you have any questions, feel free. You can reach out directly to Bob or myself, or you can reach out to your advisor with any questions you might have, and we'd always be happy to answer them or to walk through anything in more detail. So we thank everybody for joining us, and have a good week.